An ETF, or Exchange Traded Fund, is a way that investors can participate in the growth of a group of companies without buying stock in each one. This group of companies is typically known as an index, like the S&P 500, and provides investment diversification to help mitigate risk, compared to investing all of your money in a few stocks. Let's use an analogy to illustrate. Suppose you have a strong interest in fine art collection. Now you could go out and buy a few Cézannes, a Degas, a Monet, and a Manet, but you'd need to round up tens of millions of dollars to do it. However, what if a company purchased the fine art, packaged it together, and offered to let you purchase shares of ownership in the collection? Well, this is similar to how an ETF works. An index, say the Impressionism Index, can be created to inform investors of the value of these works of art. The art, representing stocks or other investments, is bundled together into an art collection, the ETF. Shares of the ETF are sold to investors, and as the value of the art in the collection rises or falls, the value of each ETF share does likewise. So far, an ETF is probably sounding much like a mutual fund. They are similar, but with some distinct differences. While some mutual funds are purchased or sold by paying a front or back-end load or fee, ETFs are purchased or sold by paying a commission. Why the difference? Continuing our art collection example, if you had a few shares of the Impressionism ETF to sell, you could sell them during market hours to another investor. However, a broker is required to facilitate the transaction and is paid a commission, much like an art broker would be paid a commission to facilitate the purchase of an art piece. Mutual funds are redeemed at the close of the trading day directly with the fund manager, so no commission is required. One of the virtues of ETFs is that since they track an existing index, they are passively managed, rather than a mutual fund actively managed by a fund manager who buys and sells investments more frequently. As a result, management expenses for ETFs are kept lower than many mutual funds. Due to the structure of an ETF, investors can purchase as little as one share at a time with no investing minimums. So if you had $500 to invest in an ETF, and the market price was $50 per share, you could purchase 10 shares. Mutual funds are also purchased as shares, however, they often have investing minimums, often thousands of dollars. If you sell your ETF shares, you'll receive the market price for the security, but you may not be thrilled with the price. At the time this video was published, there were nearly 1,400 different types of ETFs. Many of these ETFs track highly liquid, popular indexes. However, others may track relatively inactive or lesser-known indexes. Selling an ETF with low liquidity means that the market may not be willing to give you the price you desire for your shares. This would not be the case with a mutual fund, where you sell your shares back to the fund company at the NAV, or net asset value, calculated at the end of the trading day. As mentioned earlier, a big virtue of ETFs praised by investors is the ability to trade them during market hours. However, investors should be careful that this virtue doesn't become a vice. Intraday trading may tempt investors to trade more actively, but the problem with this, as we've discussed in another video, is that even professional investors can be poor market timers. Studies have shown that investor returns tend to underperform investment returns in the same ETFs. As with all securities, investors should mind the market risk of ETFs. The share value of an ETF in your portfolio is derived from the underlying securities, just like the shares of the Impressionism ETF are valuable or not because of the art itself. ETFs can be purchased for your brokerage, IRA, or other investment account from Zions Direct. Open an account today at zionsdirect.com. And to continue building your investment knowledge, subscribe to the Zions Direct YouTube channel.